Good afternoon, everyone. Thanks so much for joining and welcome to today's economic webinar hosted by Whitaker-Myers Wealth Managers. I'm John Mark Young, President of Whitaker-Myers Wealth Managers, and we're thrilled to have you join us today for what promises to be an insightful and a thought-provoking discussion on the current state of the economy and its implications for your financial future. And certainly, probably everyone is very interested to hear what Andrew's thoughts are on the current state of the economy pending what happened about 2 weeks ago. At Whitaker-Myers Wealth Managers, we pride ourselves on empowering our clients with the knowledge and tools needed to navigate today's complex financial landscape. We pride ourselves, one of our core values is having the heart of a teacher. And events like this are an integral part of that commitment to keeping you informed, prepared, and educated. And today, just like last year, this time in November, we are welcome to have a distinguished guest. And I am, one of my side gigs is a PA announcer for a local high school. And so I get the fun pleasure of trying to announce and enunciate crazy last names. And there's not one that's harder to enunciate than Andrew's. I'm going to try this, Andrew, and you can correct me when you get going. But Andrew Opdyke, who is a senior economist at First Trust Advisors. He brings, of course, a wealth of experience in analyzing both global and domestic economic trends. We talked about a lot of global and economic trends last year when we had this conversation and how we can translate them into actionable insights for you as an investor and certainly for us as financial professionals. He's been with First Trust for nearly 12 years, 10 years as one of their top economists, working alongside Brian Westbury. You can see Andrew on television stations such as Fox Business, CNBC, and he is uniquely equipped to guide us through the uniqueness of today's markets. Now, during this session, Andrew's going to share his perspective on key economic indicators, market trends, and the potential impact of fiscal and monetary policies. And whether you're curious about inflation, whether you're curious about what's going to happen with interest rates, certainly that paradigm has changed since the election quite a bit, or future market outlooks. This is your chance to gain valuable insights from one of the industry's most respected voices and from one of the industry's most respected firms in First Trust and Andrew, respectively. But before we begin, and I'll kick it over to Andrew, a few housekeeping notes. We're going to reserve time at the end for a Q&A session. Please drop your questions into the chat box throughout this webinar as you have a question, and we will try to get to as many of those as possible. Additionally, we'd like to remind everyone that this session is being recorded, so if you have any privacy concerns, please don't put any personal information in, and it will be shared with attendees afterwards for your reference, so you will get a chance to rewatch this after the event. So without further ado, please join me in welcoming Andrew. And Andrew, thank you so much. Just as last year, thank you for being here today. We are incredibly excited to hear your insights on the economy, the markets, the post-election. But before we get into that, and of course I won't badger you on the Northwestern thing like I did last year because, well, that's a little raw after Saturday in Ohio State doing what they did to you guys. But I will say this, how did I do with my PA announcing as we enter basketball season on your last name?
It is one of the harder last names. It's pronounced Opdyke, like it should be spelled with a U. I'm not sure which of my it's gone through many iterations over the year, but it's one we always had to spell it out anytime we made a dinner reservation and introducing growing up. So thank you for the very kind introduction. I am having some technical difficulties on my end. John Mark, are you able to share the slides?
Yes, sir. I'm going to put them on the screen as we speak right now, and you just direct me as you want me to go, backwards,
Fantastic.
forwards. But we will share them on the screen right now, and I will put it on a full screen, so hopefully you're able to see that.
Fantastic. Thank you so much. Well, we have a lot to talk about. We're sitting here now. The election is done. We've got the rest of this year to look forward to. And the scenario, what we saw out of the election results, we saw something happen that happens time and time again through the election cycles here in the United States. When the election results were in, roughly half the country was happy, roughly half the country was upset, and then everyone got back to work, and Apple confirmed they're building another iPhone regardless regardless of who ended up in the White House. But because we did get a sweep, we've got Donald Trump going to be the 47th president of the United States. We've got the Republicans picking up 4 seats in the Senate. We've got the House going Republican, though with a small majority. It does put more on the table as potential changes that we will see in the year ahead. So what I'd like to do first is walk through what are some of the ramifications of the election results that we got? And there's a few things. The number one item that leading into the elections was going to be a critical decision based on who was going to be in the White House is what was going to happen with the Trump-era tax cuts put in place in 2017, started in 2018, expiring at the end of next year. There was this question of, as we moved into 2026, depending on the makeup between the White House, the House, and the Senate, we could have seen these completely eliminated. We could have seen some negotiations take place where some pieces were extended and some pieces were allowed to return to higher tax rates. With the Republican sweep, we are going to see the full extension, I believe, of the Trump-era tax cuts, but with some additional changes coming as well. Now, there's 2 critical parts to this as we think about the tax cuts, and this included the corporate tax change that brought rates down from 35 to 21. This included impacts on the top personal tax rates. This impacted inheritance laws. This impacted dividend and cap gain rate potential changes. What I think we're likely to see is the full extension of the 2017 tax cuts, as well as further movement on corporate tax rates. Now, this number, which has been at 21, moved down again from 35. That puts us, if we look at the largest developed nations around the world, the top 10 largest goods-producing, service-producing, economic output nations, this puts us kind of right in the middle of the pack, middle to slightly upper end. The discussions right now are moving this into the range of 15 to 18%. Now, if you go back to 2018, wave of Trump-era tax cuts, what we saw from the market standpoint was about $5 in additional earnings gains within the market. At the same time, companies, when they saw lower tax rates, as well as some shifts to the depreciation schedules, accelerated investment into their businesses. Now, what that meant is that from an earnings standpoint, and I am a critical believer in that earnings drive markets over time, this had a notable impact on markets. Now, I do need to caution here. When we had those earnings gains back in 2018, if you remember, the markets that year actually ended up down, which is completely counterintuitive. Now, why in the world did we see 20% earnings growth and yet the market moved down? It's because the emotion side of the equation came into center stage at the late part of that year. At that time point, people were talking about the Federal Reserve potentially raising interest rates. There was discussions around the government shutdown. CNN was running this ticker on their screen every day talking about how the government shutdowns, every day that was going on, it was going to subtract from U.S. growth, and they talked about it day after day after day after day after day until the results came out, and it turned out they were completely wrong. And we all remember that day because the next day is when they ran the apology special. No, they didn't run an apology special. They moved on to whatever the next crisis would be. But during that time period, the emotions ran high, counteracted the real economic performance that was happening underneath. And it wasn't until 2019 that we saw the market reward the gains that were taking place. When we see movements like this, when we see things like the tax cuts, these are a tailwind from a market standpoint. Now, in addition to lowering the tax rates, and this won't be to the same degree if they move down from 21 to 15 or to 18, it's a smaller change than the 35 to 21. We anticipate it would have about a 5-ish% move in earnings, but there are other areas they're going to see movement as well, and one of those is targeted tip relief. Now, this was really brought into the fore because of Nevada. When the candidates were running and trying to drum up votes in the state of Nevada. There is a large contingent of voters who are tied into the service industry, who are tied in, whether that be casinos, whether that be related to food service. And this was an area they really wanted to focus on in order to draw support for those votes. Now, they're going to have to be very targeted with this. If they just broadly said, look, all tips are going to be untaxed, and there's been discussions about movement on overtime as well, it provides an incentive for businesses to shift how they're paying employees, how they classify payments. So I think you will see movement on tip relief, reduced taxes on tips, but there's going to be qualifiers that are put in place. Now, the major question that's out there that is still to be determined on the extension of the tax cuts is, are they extended for another 8 years, or is this made permanent? And in order to make this permanent, they would have to find offsetting spending declines, okay, that would fully offset the reduction in expected revenues. And this could be difficult, but there are a few areas where the Trump administration has already said, here's where we're looking to try to find some savings. Reductions in green energy subsidies, that is number one, and also focus on reforming Medicaid and the Affordable Care Act, Obamacare. I think on the Medicaid side, there's going to be discussions about block granting that to the states, putting it down at the state level, trying to find some cost savings, some improvements in output. The reduction in green energies is an interesting one. And it's interesting for a few reasons. One, a lot of green energy activity takes place in Republican states. In fact, one of the biggest states for green energy activity is the state of Texas. And while there have been discussions when Trump won the election, they said, oh, look, you know, what happened with the Inflation Reduction Act that was passed under Biden, there was a lot of calls. They're going to look to reverse all those measures. But here's something to remember, that when Biden and company put the Inflation Reduction Act into place, one of the things they did quite intentionally, and I think quite intelligently, is that the majority, more than half, of the funds that were distributed in the Inflation Reduction Act were distributed to Republican states. Now, you may see some things like reduction in subsidies for electric vehicles. There have been people that said, well, is that really going to happen? You've got Elon Musk, who played an important role in kind of promoting Trump, distributing information, and he obviously is the leader of Tesla. Now, at this point in time, Tesla is okay with a reduction in electric vehicle subsidies. They have a controlling stake within the electrical vehicle market here in the United States. If they can get tariff increases on China to further protect Tesla from foreign cars coming in, and really BD is the main company, causing issues in terms of market share in the United States, they're okay with seeing some reductions in electric vehicle credits, particularly in the lease credits, because it makes it harder for their competitors to compete in that space. But because of the activity that takes place in red states, I don't think we're going to see a full reduction in renewable subsidies. I think you'll see some paring back. We're also sitting here at a point in time, and this ties in with the tariffs, which again has been another major discussion point, an area where economists and market commentators have said, if the tariffs get put in place as proposed, if we get 60% tariffs on China, if we get 10 to 20% tariffs on everyone else, blanket tariffs, that is inflationary. That in addition to movement to reduce immigration, they've talked about deportation, those two pieces would be inflationary impacts on the United States. But again, here's an area where when Trump was out campaigning, and this is something we learned during the first administration, you always want to take Trump seriously, but I wouldn't take him literally. Okay? And what I mean by that is I do think Trump's going to go in there and in day one say we're going to increase tariffs on China. Look to do, let's say, a 60% tariff on China. Now, right now, a lot of the tariffs, depending on where you're looking, what products, are typically closer to 30% on China. If you look more broadly, if you look at the U.S. versus their 10 largest trading partners, who we do the most, combined imports and exports with, out of all of those nations, we are just the second highest, we are actually the second lowest in terms of tariff rates that are used. Singapore, who's one of our trade partners, has 0% tariff rates. But as we stand today, the tariff rates here in the United States are lower than anything you see coming out of China. It's lower than what you get coming out of Europe. It's lower than what we get from Canada, Mexico, Japan. The U.S. average tariff rate today of 3.4% is one of the lowest in the world. So as tariffs are potentially put into place, remember, put that in the back of your mind, that we are coming from the freest, one of the absolute freest trade countries in the world to slightly higher tariff rates. We're not going to catch up. India right now is over 13%. South Korea, Brazil also over 13%. China's at 10%. Vietnam is at 9.6%. Mexico, Malaysia, the whole European Union are over 5%. As some of these tariffs get put in place, what it's going to do is it's going to move us again towards the middle of the pack. But when we've heard discussions coming out of the Trump administration and people that have been proposed coming into some of the positions, the discussion that's taking place is tariffs are a tool. And by that, there have been discussions, for example, Europe and the Russia-Ukraine war. There have been discussions saying Europe, the U.S. has been the largest provider of weapons, the largest provider of healthcare relief, of food to the area of Ukraine. We have been the largest spenders in terms of helping Ukraine fight that war, and there were commitments from places like Germany. There were commitments from a number of European countries to raise their contributions and also to raise spending on their defense as a percent of GDP that we have not seen come to fruition. And I wouldn't be surprised to see Trump come into office and say, look, Germany, here's the thing. We've asked you on a number of occasions to help to provide greater assistance to this war with Ukraine and Russia. And here's what we would like to do. If you step up to the plate and if you work to do that, then we don't put tariffs in place. But if you will not step up to that obligation, then yes, we're going to put some tariffs in place. It may be broad-based, it may be targeted, and we'll use resources from that in order to essentially carry the weight that we've asked you to do. Mexico is another example. There's been discussions. Mexico, we need greater protection at the southern border. We need more activity coming from your side. And here's the thing. If you will do that, if you will step up to the plate, if you will provide additional resources to help us with this area where we are having an issue, then we avoid putting the tariffs in place. And I think they really want to keep those numbers low. I think all else equal, Trump signed a new trade deal with Canada, with Mexico, as well as with Japan during his first administration. And since then, Canada and Mexico have become the number one and number two trade partners of the United States. China used to be number one. But as we've run into difficulties with China, as we've run into difficulties with the adherence to copyright protections, as there's been fights in terms of, we are now sitting here today, China is the second largest economy in the world, but they're running into some difficulties with declining populations. There's been some unrest. They're running into some economic difficulties. China has tried to flex a little bit on areas like Taiwan, areas like the South China Sea. They really want to be global leaders in semiconductor production and AI. And because a lot of that is in direct competition with the United States, and because semiconductors and that AI technology has heavy tie-ins to defense, the U.S. has really targeted China, whether that's, again, with tariffs or just with world. They said, look, this is a fight we need to take. We need to make sure that we, the United States, China is investing heavily. We need to make sure from a security standpoint, from a defense standpoint, from an economic standpoint, this is a critical area. And it was going to be a critical area, regardless of whether it was Trump or Harris that was going to be in the White House. Now, watch what happens in the first 90, 120 days. You will see probably some initial first 5 days, 10 days, big announcements on what's going to happen on tariffs, what's going to happen on immigration. Let's see how quickly those get moved upon, because I do believe that if you see heavy movement on tariffs, that you'll see scaling back, that you'll see a number of agreements come in, that countries will look at this and say, we're not sure how serious Trump is, but we want to avoid the risk that the U.S., the largest purchasers of foreign goods in the world, we want to make sure that we're not on the wrong side of that trade. Now, again, this leads to some potential disruptions. There could be some volatility as everyone ultimately sees exactly what policies are going to get put in place and exactly how intense those policies will be. There is the risk here of inflationary pressures. There's also the risk of tremendous incentives for business investment. If you are a country, if you are a company, Black & Decker's talked about this, if you're a company that has production in China, that has it in Brazil, that has it in somewhere in Europe, and you said, look, I don't even want to have to worry about the country negotiating on these tariffs. I'm just going to bring that plant to the United States. You're a semiconductor company. We've seen massive investment by companies like TSMC, like Samsung, that said, look, we're going to avoid dealing with these potential tariff issues by placing production in the United States. I think that's a trend that you're going to see. Now, that means, all else equal, this looks like it could be quite a strong tailwind for U.S. corporations, which typically flows through to the earnings side of the equation. The group that's really going to have to deal with some of these consequences, who's getting caught a bit flat-footed here, is the Federal Reserve, who started the process of cutting interest rates earlier this year. They made their initial cut of 0.5% at their recent meeting that took place the day after the elections. Chair Powell said, look, we're going to continue cutting rates. We know that there's the risk of some inflationary impacts coming from changes in policy. We're going to wait and see exactly what happens on that front. We've got time to see, what policies do get implemented and how inflationary we think they will be. In the meantime, though, we want to start lowering rates because we do have some areas of risk. If we look at the slide called Getting the Jobs Back, this is an area that's come to the forefront. Now, the Federal Reserve has two main tasks. Okay, the two things that they are tasked with is, one, maximum employment, trying to get as many jobs out there as possible, trying to promote a low unemployment rate, and then two, they're tasked with inflation. Now, over the last 4 years, the inflation mandate has been front and center, with inflation rising, reaching above 7%, rising at the fastest rate that we had seen in decades. At the same time that the unemployment rate was near historical lows, the Fed raised interest rates, saying we have room to move. We can raise rates, put some downward pressure on incentive for businesses to invest, for people to borrow and buy homes or buy cars, to borrow and go to school. We're going to disincentivize some of that activity. We're going to allow the unemployment rate to start to come up, and we're going to look to bring inflation down. If we reach a point where the risk on employment starts to rise, we can react. But as it stands in 2020, 21, 22, into 2023, they said inflation is problem number one. Of late, that started to shift. We've seen the inflation numbers. They're still above 3%. CPI, the Consumer Price Index, we got that data recently. That's still at 2.8%. If you strip out the food and energy has been a major factor, bringing some of the costs down in the last year. If you strip out those two volatile categories, we're still over 3%. But employment has become a central focus for the Fed. They said, look, we're starting to see some weakness. We're starting to see some areas that concern us a little bit. Now, looking at this chart of Getting the Jobs Back, the pace of job gains today doesn't look that different from what we had pre-COVID, what we saw in 2018 into 2019. If you just look at the chart, it looks like we've essentially gotten back to trend. Here's where we need to dive beneath the details. Start looking at, where are the jobs being created and how good are the jobs being created? Let me ask that question, the first question first. Where are the jobs being created? If you look back to that time period in 2019, okay, we can break down what sectors, what industries were leading growth, okay, and we can do the exact same thing today. And what I can tell you is that today, over the last 12 months, there are two sectors, just two, that are representing about 2/3 of all job gains. Now, for comparison, back in 2019, these same two sectors were about 12% of job gains. So, what are these two sectors that are running 4 or 5 times hotter than what they were pre-COVID? What are these two sectors that are dominating employment growth in the United States? They are number one, largest contributor to job gains in the last year, 18 months, has been government payrolls. The second highest has been healthcare. Okay. Now, again, these two areas, what that tells you, if you look at, again, the pace of growth is a bit similar to where we were back in 2019, but at that same pace of overall job gains back then, 88% was coming from the broader economy. It was coming from manufacturing companies, from telecommunications, from utilities, small and mid-sized businesses, mom and pop shops. Those groups are representing a much smaller portion of job gains. In fact, they're hiring at much slower levels today than what we saw back then. And this has impacts. It has ramifications on sustainability of economic consumption, economic production as we move forward. The Fed would love to see a broadening out. Now, maybe you say, hey, at least a job is a job. And whether it comes in one of those small and mid-sized businesses or it comes in a government job, at least a job is a job. The question then becomes, how good are the jobs? Are these full-time jobs? Are these part-time jobs? And in a normal expansion, in a normal period of job growth, greater than 100% of jobs are coming in full-time. What you typically see, I'll give you an example. If we have 185,000 jobs that are being created month in and month out, during expansions, typically 190,000 full-time jobs will be created, and there's actually a reduction in part-time work. As the economy is booming, as it's growing, people who are working part-time but maybe wanted full-time positions are able to find those jobs, and they make a transition over. So as we sit here today, what percentage of job gains are in the full-time versus the part-time? Well, unlike in prior time periods where full-time jobs were 100% of the gains, right now we're exactly the opposite. If we look at the next chart, getting the jobs back, showing full-time versus part-time employment, over the last 12 months, we're actually down over 1 million full-time jobs. The entirety of net gains have come in the part-time sector. Now, have we seen that before? The next slide shows, yes, we have. We have seen time periods, twice in the 70s, twice in the 80s, once in the 90s, twice in the 2000s, again in 2020. We've seen full-time jobs decline before, but historically, that's been associated with a recession. Every other time that's happened in the last 55, 60 years, it's come with an economic slowdown. Now, we are not in a recession today. We are not. But the Fed looks at this and says, all else equal, we would love to see broadening out. We would love to see more activity, investment coming from small and mid-sized businesses. We want to reduce rates. We want to incentivize these companies that have gotten priced out, that have had difficulties in these fields. We want to get them back in the fold. We want them to be hiring, so we're going to go ahead and start this process of lowering rates. Now, they know that inflation is still a problem. And in order to understand why inflation is still a problem, I want you to take a look at this chart showing where are we spending? Where is the consumption taking place, goods versus services? This is a really interesting chart to me because you see in the 2000s, the 2010s, goods and services were growing at a pretty consistent pace. There were not large month-to-month deviations. They were kind of growing on similar trends. We spend more money in services than we do on goods, but things changed substantially back in March and April of 2020 when the doors closed and we weren't sure if we were allowed to go to the grocery store or we weren't sure if we were allowed to get a cup of coffee. Back when we went through the great toilet paper run of 2020, we saw this massive movement inside. We saw a reduction in service sector activity, even goods activity, the likes of which we haven't seen in close to 100 years. Not since the Great Depression have we seen such a tremendous and concentrated decline in economic activity, but it's what happens from there that's really interesting. If you look at 2020 into early parts of 2021, what you notice is that goods got back to trend and, in fact, above trend very quickly. As services were still shut down, as you couldn't be at the airports, as you weren't traveling and going to the hotels, as we had no live events and you weren't at the movie theaters, restaurants were doing takeout only. During that time period, we all moved inside and online. And we said, look, let's bring the world to us. Now, that caused some disruptions, and part of that was the issues we have with the supply chain, and I can only fault the Fed to a degree in terms of the discussions they had back then. They really believed inflation was down to supply chain problems. The fact that we had moved inside and we needed more truck drivers, we needed more port workers, we needed more people at the rail yards and in the warehousing centers. And so they incentivized activity towards those areas. When they cut rates, they told companies, we need you to hire, we need intense focus on easing the supply chain. So that's exactly what we saw. We saw movement away from services. We saw the workers move, the investment dollars move to where the demand was, and we made a lot of those changes by about April of 2021. Now, if you're looking closely at the chart, April of 2021, from that point forward, you kind of notice a notable shift. The goods start to trend almost dead sideways, while service really starts to accelerate. During that same time, right after we made a lot of these moves, is when we started seeing people say, you know what, I'm getting back outside. I'm going to take those trips. In fact, I'm going to take 2 vacations this year to make up for the ones I didn't take. I'm going to go see those relatives this year for the holidays. I'm going to go out and have a meal with friends, with family. Let's catch up with everyone we didn't see. But we have seen this create a whole new set of inflation problems. And it's something that, honestly, the Fed wasn't anticipating. See, they looked at that good line. The line for goods that's been flat since April 2021, and if I had told you the scenario that we would be seeing in advance and asked you what you would expect to see happen, 9 out of every 10 people and 10 out of every 10 that took a macroeconomics class, right, they would come to the wrong conclusion. If I told you, look, on that good side of the equation, we survey these companies every month. There's a group, the Institute for Supply Chain Management. They're going to ask these companies month in and month out, how are your orders? Is it up or down? How's your production, up or down? Is your employment up or down? Do you have order backlogs? Are you able to get things in and out? How is your company doing? And if I told you that these companies, for essentially 2 years straight, would say orders are down, production's down, we've worked through our backlogs, we're not hiring. And I were to ask you, what do you think these companies are doing from the investment side? Do you think that they are, A, saying, well, now seems like a great time to be investing in property, plant, and equipment, rolling out some new product lines. Let's really grow this business. We might not have orders right now, but let's go ahead and spend anyways. Or do you think that they're moving down route B, saying if orders aren't there and production is struggling, let's hold on to what we have. Let's use what we've got. Let's temper our activity. And when activity returns, then we'll get back to business investment. The Fed was certainly expecting them to go down route B. And as they raised interest rates, it made it more expensive. When it's more expensive to borrow and buy a house, people buy fewer homes. More expensive to borrow and buy a car, people buy fewer cars. More expensive to borrow and invest in a business, people tend to invest less in their businesses. But that's not what we've seen. The next slide shows you the activity in manufacturing construction. And since 2022, the same time period, where the companies again said orders are down, production's down, they've tripled spend. Now that on the face of it, it doesn't make sense. Based on economic theory, based on Fed theory, this is not what you would expect to see happen. So why in the world do we find ourselves here? It's because the Fed doesn't operate in a vacuum, right? They don't operate in a vacuum, and at the same time, the Fed was raising rates in order to try to disincentivize activity. Congress came out and said, we're going to do the Inflation Reduction Act. We're going to do the CHIPS Act. And we've seen massive investment. Ohio is a flagship, right? You go out to New Albany. If you've seen the Intel plant that's going in, the scale of that project is immense. I was down there earlier this year, and I remember as I was rolling into New Albany, the first thing that hit me before I ever made it to the site was that all the roads were new. And there was so much activity going on the sides of the roads, and I started diving into it. I started looking into what was taking place, and what I found was the scale of the electricity needed for this plant to function, the scale of the water needed for this to function. On the water side, this plant, the Intel plant going in, that's expected to have 3,000 to 8,000 employees when all is said and done, is going to use twice as much water per day as the entire Ohio State University complex, with over 100,000 faculty, staff, and students. The power demand just from these data centers, from this AI, this activity that companies are investing in over the next 2 years, the growth in data center demand alone is expected to exceed the yearly power demand from the country of Japan. There is massive investment taking place. There's massive construction activity taking place, despite a lot of the companies on this side of the economy not having the demand at the moment for their products. But at the same time, these companies are having to make a decision. If we're waiting and we're making these investments, we're making manufacturing investments, green energy investments, chip investments, If we're doing this and we have plants that are going to open in 12 to 18 months, are we willing to let go of workers today and try to hire back in 12 to 18 months? We just went through COVID, where it was unbelievably difficult to hire. Are we going to let people go? And the answer has so far been no. And so what this has done is it's made the Fed's job difficult. If we look at what's driving inflation now, the next slide, what you see is that the blue line, core CPI, it's down from its peak. That's core excluding food and energy. This is the number the Fed really cares about. You'll notice the last few months it's gone straight sideways. It's been stalling out. But what you really notice is that the orange line, the good side, which was such a big focus for the Fed early on in the process, and they said, let's address it. Let's get the supply chains fixed. As they fixed that problem, they brought that inflation down, but they also moved the inflation problem over to services. You notice that as goods is coming down, the service side is rising, because they started to have shortages finding workers. They started to have shortages as we moved the resources away. And that side, which is where we spend more of our money, is still today having difficulty. The inflation there is declining. It's trending lower because really who it's focused on, the pain has come to the small, mid-sized companies who have said it's been really hard for us. The cost to borrow and invest in our projects, the cost to borrow and to pay our rent, to buy our inventories, it's made it difficult to play. We've seen more and more small and mid-sized businesses stepping back. Now, what's going to happen as the Fed cuts rates, if their goal is to incentivize this same group to come back and invest, to come back and hire, it's probably going to put inflation pressures here. But I found it interesting. I had a conversation with some members of the Fed, and I asked them, where are you concerned on this chart about inflation getting down to 2%? And they actually pointed me to the orange line. They said the goods is where we have some concern. Now, you can see of late it started to tick higher, but they said this is really going to be something we need to watch going into 2025. This is beyond anything related to tariffs. This is beyond what's going on with immigration, but it's going to be impacted. See, the issue they said here that they've been focusing on over the last 6-9 months has been geopolitical conflict, specifically what's going on with Israel and Palestine, what's going on in Gaza, what's going on with Iran. They said the attacks that have been happening in the Red Sea. Hamas has been firing on ships going through the Red Sea on their way to the Suez Canal. Now, the Suez Canal is the single most important trade route into Europe. And because of the firing on the ships, we've seen about half of that traffic reroute away. So we can't go through there. They've been rerouting, and instead of going through the Suez Canal, they're going down below Africa via the Cape of Good Hope and coming back up to reach places like Europe. Now, what that's doing is it's moving freight rates. The next slide, looking at global freight rates, you can see that they spike when there's escalations in conflict, and then they start to calm, and then they tended to rise further and then calm. Now, this number we could see rise towards the end of the year. There's going to be activity coming from companies saying, we don't know what's going to happen with tariffs. Let's bring in as much as we can before they go into place. In December, in January, whatever you have, send it. Let's build up our inventories that way. Regardless of what the number that gets put in, we've got some protection on it, but these freight rates are starting to flow through the system. So many things get shipped for both the goods and service side of the economy. Now, these freight rates, they don't show up the next day, they don't show up the next week, because a lot of these companies have contracts that are 6, 9, 12 months out. What you start to see is this rolling in. As some of those contracts roll over and they're starting to see these higher shipping costs, these higher freight costs, and we still don't know what this full scale is ultimately going to be in the Israel region. There's still pressure that could bring this number higher. This is one of those things the Fed's looking at, saying beyond the tariffs, beyond reductions in labor from immigration, we have some geopolitical concerns across the board, right? The net result is that the Fed is sitting here saying we need to be cautious. And Powell conceded to this late last week. At a meeting, he was speaking in Dallas. He said, we need to take a cautious approach. We can move slower. The market's still pricing in that they'll move in December, cut by another 0.25%, but it's coming into question. As the economic data comes in, as we see the impacts, it could cause the Fed to move slower than many are anticipating. Now, normally I would say, hey, at the end of the day, as the Fed is on their path, we need to wait and see exactly what policy gets put in place, but the ultimate drivers over time are interest rates, And the next slide shows you the orange line there, 10-year treasury yields. What is the cost to borrow and invest in products? That level is no longer rising like it was. It's been bouncing around. It's been a bit volatile. But companies have a little more predictability that we're not going to move substantially higher. Nobody's really expecting the Fed to raise rates substantially. It's a question of do they pause or continue cutting. This is trending in a direction that companies have some confidence to invest. And if we look at earnings, the next slide, earnings are projected to grow this year, projected to grow another 12% into 2025. These are critical drivers of market performance over time. More so, what happens if we look at the earnings growth and you look at this chart, 2009 to 2024, right? What you see is growth and progress, as I mentioned. You can see from 27 to 2018, you can see the impacts of the tax cuts, you can see the impacts of COVID in 2020, and then the surge in activity that followed. But I'll tell you this, what's been happening beneath the surface, what drives earnings here in the United States is not whether the Fed moves at the next meeting. And yes, politics impacts, it influences, but at the end of the day, what's been driving this has been the people. The entrepreneurs, the innovators, the risk takers, building companies, building ideas, that's what's grown these earnings over time. And what I want to finish with the last few slides, I've got 3 slides left. I just want to let you, and I want you to see, because we don't hear this enough, what's taking place around the world. As we are, even though there's discussions on tariffs, we are in an increasingly connected world. As places like India are growing and they're becoming more engaged in the global economy, as we're seeing their population start to prosper, what it does is these emerging nations, as they grow, they want greater access to the innovations, the products, the technologies that the developed worlds have, and those are disproportionately coming from the United States. When I look at the slide of global adult literacy, okay, this trend that's taking place, this unleashing, this unlocking of human potential is happening today at a rate we've never seen. It's incredible for me to stop and look at this chart and think it wasn't until the 1960s that we passed more than 50% of the world's population being literate. It wasn't until the last 60, 70 years we reached the point where more than half of adults could read. For the history of the world leading up to that point, we were never there. Go back 100 years ago, 200 years ago, and it was less than a third of the population. 200 years ago, 1 out of every 10 people could read, and that impacts your ability to read, to grow, to learn from those who came before you. Education and technological advancement are accelerating as people have the capacity. Let's add in that you go back to the 1960s, there was about 6 billion people on this earth. Today, we're between 8 and 9 billion. If you look at where we stand today, we've got more people than ever before, with better sanitation, better health care, better nutrition than ever before, with a greater capacity to learn. If you look at the next chart, the share of world population living in extreme poverty, it's not a coincidence this is moving in the exact opposite direction. With that capacity to learn, with that capacity to produce, to become more productive, if we think about the technologies, I was having this conversation with someone the other day. We were talking about the advancements here. We've got Black Friday coming up, and they were talking about going out to purchase the TV, and the ads are starting to come out. You can buy a 65-inch flat panel, 8K, ultra-high definition television for about $250. And it made us pause and step back and say, you remember Y2K? Do you remember 25 years ago what we could get for $250? So we look back, and for $250, 25 years ago, you could buy a 25-inch tube television. And we thought, man, I thought we had flat panels back then. We looked in 1999. Sure enough, we did. For about $3,000, you could buy a 32-inch flat panel TV. And when you pause and think about that, how much is a 32-inch flat panel TV today? Most of us wouldn't buy one. Now it's too small, but you can still get them. They run about $60. And you think about what that means. As the world's population has not only gotten better access to learn how to read, they've also gotten better access. The luxury items of the United States 25 years ago are becoming commonplace in emerging market nations, the use of cell phones, the connection to the internet. We have people today in countries like Bangladesh where the government gave us statistics saying there was more people with cell phones than electricity in their homes. These people can connect online and have greater access to information in the palm of their hands than the President of the United States had 25 years ago. And the last slide, sometimes these numbers are hard to understand, the magnitude of what these gains are. So let me just give you this number. These are the stats. The World Bank defines extreme poverty as the number of people living on $1.90 per day. And back in 2003, 1.6 billion people. 20 years later, latest data we have, 713 million. Now, is that 713 million too many? Yes. 713 million. I want to see that number come down. I would love to see this poverty eradicated. At the pace we've seen over the last 20 years, we're on pace to do that in the next 20. But think about it. Over that 20-year time period, we saw 906 million people, almost 907 million, move out of extreme poverty. Over that period of 7,305 days, we have averaged over the last 2 decades, we have averaged over 124,000 people per day moving out of extreme poverty. We've unleashed human prosperity. We've unleashed human potential. And while we have these trade wars and we have these disputes and we try to negotiate between the countries, let's never lose sight that behind the scenes what's taking place is innovation at a scale we haven't seen. As we move into next year, there's going to be discussions on whether that innovation is taking place at plants that are being built here, being built in places like India. I don't think all the activity, as we put more pressure on China, I don't think all of that's going to come to the United States. I think you're going to see beneficiaries in India, in Vietnam, in South Korea, in Mexico. And you're going to see a lot of focus from the U.S. on building deeper relationships, deeper trade relationships, economic relationships with these countries that we have greater confidence. I think that's going to be a trend that we're going to see over the next few years in these earnings drivers. What these people do, what we create, what we build with the AI, with the new chips. Over the next 5 years, I'm incredibly excited to see what comes. We'll adjust and we'll make movements based on exactly what happens on tax policy because that impacts all of us a little different. We're going to react to what happens with tariffs. That'll impact industries differently. So we do the day-to-day. We do the week by week, the month by month, with all of the turning of the dials as individual policies come in, as shifts take place in administrations, but we never lose sight of the bigger trend that's driving us forward over time, that's propelling the earnings growth that really drives us. Now, you just listened to an economist talking for more than 40 minutes. That's longer than we could keep anybody awake back during economics class. And I wanted to make sure we have hopefully a couple minutes here, at least at the end, for any questions. If there's anything that's come in, any questions you have on things we talked about or didn't talk about, I would love to dive into those. And I can't see the question box. So, John Mark, I'm not sure if you could relay those.
Yeah. Yep. Yeah, I do have them. And just a reminder for everyone, you can chat your question right into the chat box, and we will ask it to Andrew. So while, Andrew, we wait for those to tabulate and people to come to us with their questions, I'll start out and throw one over your way, which, by the way, 45 minutes. But you are, my friend, engaging. That's probably something that Northwestern taught you really well. Their education is great. Their football, again, leaves something to be wanted for. But I think you guys get a new stadium, so maybe that's going to improve the play on the field.
I'm not holding my breath.
So one of our tactical themes on our international portfolios is India right now. We really like that. We really like that play, and for a lot of the reasons you articulated. The just massive, lower class moving into the middle class and the literacy rates, the educational or the college system there in India. But I wonder if you could speak to, I do believe I heard Jim Bowen, the CEO of First Trust, talk about how India was one of our largest customers, the United States, in terms of energy when we were at our peak during President Trump's last term in office. I wonder if you think that will continue to play out during his next 4 years, and if that provides the economic ability. Of course, as we know, a lot of the economy and President Trump is very focused on energy because he thinks so much of the economy runs through that. We know that, but we wonder if that's a even stronger impetus for India, and is that India, would that be one of your favorite emerging market opportunities right now? Maybe you mentioned Vietnam, some other ones, but just maybe speak to that a little bit more.
Yeah, no, energy is going to be central to so much of what is taking place. Whether that's the domestic production, it's really going to be an all-in plan on energy, which is why, again, we were talking about, and people have said, is Trump coming in? Is that going to throw renewables back? I think, with reductions in subsidies, some of that's going to have to really fight under its own weight. But the demand for energy, both here and internationally, and what the U.S. wants to do, what Trump would like to do, and this has been a focus, if you look at who he's picking or proposed for the Energy Secretary, the Director of the Interior, these are groups, these are individuals who have expressed a lot of interest and a lot of expectation, right? You've got the governor of North Dakota, one of the biggest states producing, one of the leaders of one of the companies that was innovators with fracking and really producing that gas here in the United States. There's going to be a focus on export. I think we're going to see movement on export terminals, and the impetus here is that as the U.S. has grown to be the world's largest energy producer, we have a capacity to engage on a global scale and minimize some of those particularly Middle Eastern geopolitical conflicts. You take power away from some of these oil-producing nations because they have influence on. Russia's really fighting. China's fighting for influence on India. They realize India's going to pass up China to be the world's largest population. In fact, I think it's now happened. They're going to continue to grow, and for the U.S., one of the most amazing things is that when Britain was involved with India, they left behind, as they left India and India developed on their own, they left behind some of the private property rights, rule of law, democracy that we see in places like much of Europe, and what particularly we see here in the United States. They're in a better position to grow and to build, and so we want to make sure, the U.S. wants to make sure, Europe wants to make sure that if we can be a critical provider of technology to India, if we can be a critical provider, and South Korea also really wants to get on that train, Japan really wants to have access to U.S. energy production. Our liquefied natural gas, it is still cheaper for us to produce it here, freeze it, ship it, get it over across halfway around the world to these other countries, unload it, and it is still cheaper for them to get it from us under that method than it is through some of the pipelines and some of the other resources that are over there in Europe. And so I think that is going to be, again, it's going to be a deepener on the relationship side if we can help build that infrastructure. Now, India is my favorite area on the emerging markets. I think they're going to be a tremendous story here over the next 20, 30 years. Vietnam had an early edge in some of the movement of companies, and the reason for that is they had developed ports and developed road systems. So if you were moving your activity, let's say out of China, but you wanted to make sure you're producing in a factory and you were going to ship it to the United States or Europe, you needed to make sure you could, one, get it to the port and get it out of the country. India still has work to do on the infrastructure investment, but they're heavily involved in that now. I think India is going to be a major developer. After India, I think you're going to see a lot of movement. This is further out. This is 2 decades, 3 decades, 4 decades from now. I think we're going to start to see some emergence coming in Africa. As, again, there's more technological growth, there's more importation of ideas and technologies. They're going to have the population, India's population growth, the U.S. population growth, are kind of unique globally. Europe is starting to see populations plateau and decline. China's already in decline. We, other than France and Europe, we and France are kind of the world's leaders along with India and Africa in terms of continuing to see population. Now, the U.S. is expected to see that number turn in about 2 decades. In the 2040s, that number will trend. And so what a lot of these nations are looking to do is similar to what Japan did when they ran through difficulties with their population. They said, look, we have ideas. We have understanding. We have technology. Let's build relationships with other countries. Let's build relationships and put our plants in places that do have these resources, that do have the workers and the growing population. And so the U.S., it's a high-level goal. it's a priority for the U.S. to deepen that relationship. And energy is such a critical input across the board that if we can be the leaders there, we can be their critical partner there, it's going to lead to developments across a number of other industries as well. So India is going to be phenomenal to watch. Vietnam, a lot of that Asia outside of China is going to be phenomenal to watch. There are a number of things that are coming down the pipeline where countries are hitting that point in that development where they're really engaging with new technologies. Education is picking up, integration with other nations is picking up, and we're really going to witness that here over the next decade.
Yeah, perfect. Maybe let's shift the topics over to interest rates a little bit. The phrase I continued to say to our advisor team and our clients in 2022 was, well, interest rates have gone up, but I just don't see them going up anymore. And I kept being wrong on that. Rates continued to go up through 2022. I feel like this year has been a little bit of that as well. September, you saw rates spike up, and to take the bond proxy out there, BND, the Vanguard Bond Fund, it had a total return of 5% this year at one point. It's down to 1.5%. So it shed about 3.5% in value. Is that simply just a paradigm shift of the Fed is going to have a different reaction? Because, of course, that's affecting a lot of clients' fixed income portfolios if you take any sort of duration, and it's affecting the mortgage market. We've seen those rates shoot back up here recently, September. What do you think is driving that, and what's the end game for interest rates as it relates to, we can look at the CME group, and their tool had a pretty drastic reduction in expectations for that December meeting in terms of percentage chance of an increase.
Yeah, I mean, the interest rate market has moved, and it's interesting because you've got the short end. Let's talk about, 3 month, 6 month, 1 year, 2 year treasuries, and you've got the longer end where you've got 10-year, 20-year, 30-year, and they can be influenced by different things. The short end, the short-term interest rates are heavily influenced by the Fed, and so as they move, you tend to see those rates come down. Now, they're very reactive. They'll move when that happens. The long end is trying to both take into account, not just is the Fed cutting today, but what ramifications does that have into the future? I think earlier this year, if we look at like May, June, July, when the 10-year Treasury was coming down, the market was pricing in that the Fed was going to move. They did their 50 basis point move, 0.5% at the first meeting, and the market was pricing in another 2.5% of cuts coming over the next 2.5 years. That is now substantially slimmed. I think part of that is election results. People, as they were increasingly seeing the likelihood that Trump was going to get elected, they said, okay, if he does do tariffs, inflationary. If he looks to reduce immigration or reduce new migration, that's inflationary. And if we see increased tax cuts, and that adds to the deficit. And this is the question, will it add to the deficit or will they find other areas to cut on the cost side? But there was the risk of higher U.S. debt. And so with a $1.8 trillion deficit last year, $1.6 trillion the year before, I think people are looking and saying, well, the U.S. is going to have to borrow a lot. U.S. is going to have to borrow a lot, and the Fed may not be able to move as fast as they were initially anticipating. I still think the short end of the yield curve, I think the Fed will continue to cut. I think they're going to move at a slower pace than anticipated, and they may have to take some periods where they take a longer pause than people were anticipating. But I do think that short end is going to start to moderate a little bit. I'm not as convinced that we're going to see significant movement on the long end, on the 10-year. And this is where mortgages, for example, mortgages are heavily tied to the 10-year Treasury. Those two kind of move together over time. And typically 30-year mortgages have been 150, 175 basis points, so 1.5 to 1.75% above 10-year rates. Now, the mortgage market, if we get the 10-year rate down to 350 to 3, that puts home buyers, and we've got a huge contingent of 30 to 39-year-olds in a prime position to engage with home purchases. But I think it's going to be hard to get there right now. I think we're still going to remain, if the 10-year Treasury is in this 4 to 4.5% range because of inflation expectations, because of slower Fed expectations, in that type of environment, then I think that housing, as it rebuilds, and it still needs to rebuild, we're 3 million homes down today in terms of inventory. We're going to see home building. I think we're going to see moderate price movement, but I think we're also going to see moderate movement in terms of people re-engaging, getting back in, and starting to make purchases. Eventually, those rates will come down. But I think, at least here in the short term, there's still too much uncertainty until we have greater clarity on just what Trump's going to put into place, just how inflationary that. If he were to do, just to throw out some numbers, if we were to see 10 to 20% tariffs, 60% on China, and this movement on immigration, the back of the envelope math says it would add about 1 to 1.5% to inflation over the next year. Now that's temporary. It's 1 to 1.5% over the next year. It doesn't add it every year continuing after that, right? So it could delay the time period for the Fed cutting. They still want to be moving in that direction. The longer end, I think, could remain a little bit higher. I do think the shorter end will start to come down. From my view, that puts an attractive area in the middle. I think that 3-5 year space, as the Fed's cutting, is going to benefit from still having higher rates, but also kind of the duration exposure on that. But time will tell, right? I don't know too many people that if you had said at the beginning of the year, the Fed's going to cut by 50 basis points later in the year, what do you think is going to happen to rates in the 3 months afterwards? I don't think too many people had on their bingo card it's going to rise by a half to a full percentage point. But it's the reality of all the moving parts. And the further you go out with interest rates, the more moving parts that the markets are trying to take into account.
Yeah, beautiful. Okay, so it's 5 o'clock, so I'm going to give you one last question, and just give me a one-word answer on if you had to summarize the U.S. economy, your future expectations for 2025, into 1 or 2 words, what would you put that? And that may be a hard question, but that's what Whitaker-Myers does, Andrew. They give you the hard questions.
Yeah. Okay, give me a second. If I was going to do one word on the U.S. economy in 2025, I think the word's going to be investment. We're going to see a lot of investment by companies. We're going to see a lot of focus on where we build from here. There's a lot of tailwinds. There's a lot of incentives for them to invest, to come here, to build. Investment is going to be a major theme in 2025.
Yeah, beautiful. Well, thank you again for hosting this in the month of November for our clients. It's always helpful to do this around the end of the year as you start thinking about the next year. You are one of the best. We're very, very blessed to have you join us. Thank you so much for your time and your attention to detail and your knowledge and passion for the economics of the U.S. and the world, and it definitely shows in your presentation. So just a reminder to all of our clients, we will record this, or we have recorded this video, and we will post that in our newsletter so you can watch it again if you missed any part of it or you would like to rewatch any part of it. And certainly if you have any questions about today's content and how it relates to you, you can reach out to your individual financial advisor or financial planner who would be more than happy to help answer any questions and relate this information to you. So thanks so much for joining us. Next month's webinar will be with our CPA, Paige Rush, and he'll be going over 2025 tax planning tips. So be on the lookout for that invite, which will be coming out in the next few weeks, and we will look forward to seeing you then. Thanks so much, Andrew, for joining us, and everyone have a great evening.
Thank you so much. Take care.